The global economy for May 2026 holds a precarious 3.2% GDP growth rate, caught directly between a booming digital landscape and severe physical constraints. Massive capital expenditures in corporate technology and sudden pragmatic de-escalations in bilateral trade are currently providing a firm floor for this growth. On the downside, maritime logistics in the Middle East face critical bottlenecks, driving an energy supply shock that coincides with a sharp spike in U.S. Treasury yields. For corporate executives, top-line stability is masking deep structural vulnerabilities that demand immediate defensive positioning. This chart highlights Morgan Stanley's new Midyear Outlook, showing global GDP decelerating only slightly to 3.2% for 2026. Trillion-dollar AI infrastructure buildouts are directly offsetting a prolonged drag in European and Asian manufacturing, propping up the broader economic index. We are also tracking a sudden shift away from supply chain protectionism as global superpowers adopt pragmatic trade frameworks. Following intense consultations, the U.S. and China have agreed to equivalent mutual tariff reductions across targeted sectors, alongside an aggressive expansion of U.S. aviation exports to Beijing. In parallel, Indian Prime Minister Narendra Modi secured a landmark strategic semiconductor agreement with the Netherlands, linking Tata and ASML. This India-EU roadmap prioritizes deep cooperation to rapidly diversify high-end chip manufacturing ecosystems, moving away from traditional East Asian hubs. These aggressive supply chain realignments, combined with massive capital expenditures, are building a decentralized technology floor to sustain international markets. This map shows the Strait of Hormuz, where regional maritime transit constraints are currently driving a severe breakdown in global physical logistics. Global strategic oil stockpiles were depleted by roughly 6.6 million barrels per day last month, pushing accessible reserves to an 8-year low to cap prices at $109. The downstream impact is faster, leaving European jet fuel with a critical 45-day runway. Higher transportation costs and rerouted shipping lines are triggering severe, sticky inflation on basic goods, threatening debt-strapped developing nations. Stickier inflation has pushed the U.S. 10-year Treasury yield up to 4.603%, making domestic U.S. debt highly attractive and draining capital from emerging markets. This sector performance heat map reveals a strict defensive rotation. Institutional capital is fleeing information technology and autos due to margin compression, moving rapidly into resilient healthcare, pharma, and physical commodities. Elevated borrowing costs and severe raw material friction are actively forcing institutional capital into safe harbors. Current tech-heavy index rallies and a 3.2% global growth rate mask intense underlying volatility. Despite equities hovering near historic highs, the volatility index is creeping upward as professional portfolio managers steadily accumulate downside options insurance against late summer corrections. To navigate this environment, executives must prioritize operational efficiency,